How did the government perform for our Malaysian economy in 2023?
Not just myself personally, but feeling was that, everyone, it felt quite depressed, right, economically.
Growth, pandemic recovery, FDI, inflation, forex, financial sector health, as well as government
Debt and revenue. Hi, this is Hardish,
And I'm Aaron.
and this is the Economy Rise podcast.
Want to understand complex economic jargon? We're here to help simplify it for you.
And our tagline is to discover the economist in you.
Right. So today's episode is basically Malaysian Report Card 2023. How did the government perform for our Malaysian economy in 2023? And what did they underperform in? Right?
Okay.
And that will also inform the data, provide the data to inform Malaysian 2024.
Right, okay. And when you say report card, you're referring to the Malaysian Economic Monitor 2023, which was released by the World Bank, right?
Yes.
Okay.
And it was also the one that Rafida recently brought up regarding the education shortcomings.
Right. Yeah.
Yeah.
So I had a quick look at the report, and I think it's there are two parts to it. The first part is on economy, right? Which I think is what you're referring to, the sort of so-called report card on our economy. And then the second part, they had a special feature on education, right?
Yes.
But I think for today we will focus on the economy part of
Right.
it, right? What I'll do is I'll ask some very basic questions. To be honest, I did not read the full report.
Okay. No worries. That's my job.
Yeah. It's only released recently, but obviously there are already some news pieces out there.
Right.
So that's the only context I have. So let me start by this. I think what I recall from 2023, not just myself personally, but the general feeling was that, everyone, it felt quite depressed, right, economically.
Yeah.
And I'm not referring to numbers per se, right? I'm just referring to
The mood.
the mood, right?
Yeah.
And I think a lot of this reflects as well. You also remember there was a lot of chatter online. Then it became a big issue in terms of the interest rates, forex, and all that, right?
I mean, I think it's no secret that everyone is a bit unhappy.
Yeah.
Yeah.
So, and generally, we covered this in one of the earlier episodes as well. There's always a difference between how we feel and how, if someone were to explain it from an economic and data point of view, then usually there's a bit of a divergence, right?
Right.
So just that point of view, if I feel depressed, or if I were to speak on behalf of my fellow Malaysians, if we feel depressed, what is the official comeback to that?
Right. So basically, what I'm trying to do here is provide meat to the meat to the bones, right? Yeah. So basically, we have a general feeling of the mood. But what do the numbers tell us? Okay. So last year, as most of us know, Malaysia's GDP growth was 3.7% after a record-breaking 8.7% in 2022. But let's remember that our average growth is around 4%, right?
Yeah.
And in 2024, the World Bank estimates it will be 4.3%.
Okay.
So still within the average. So I think what a lot of Malaysians will care about in terms of GDP growth is what contributed to it, right? So that they can better understand what will contribute to it next year. And then you can decide on your own individual terms how it matters to you.
Yeah.
So I'm looking at figure 4 of the World Bank, right? If you guys have the ability to get the report while you're listening to this, please do.
Yeah, it's freely available. Just go to the World Bank
In fact,
website.
we can make the link available down there. It's a free report anyway. So in figure 4 of this World Bank report of the Malaysian Economic Monitor, we actually get to see the breakdown of GDP growth, right? And without getting too much into it, I think what the public generally can associate with is that, one, most of our GDP growth is coming from private consumption. So that's really like service sector, retail, financial services. It's not capex intensive stuff, which might kind of walk in the face of what we expected it to be, right? With a lot of FDIs and all the recent news, right? So private consumption was still, just eyeballing it about 70% of the GDP growth.
Really? Wow.
Yeah, I mean the chart seems to say that, right?
Okay.
And then whereas the FDI component, which is under gross fixed capital formation, GFCF, again, I'm eyeballing it, but it doesn't seem like it's more than 15%. Okay, which is, to me, was surprising, right?
Do you think there's private consumption, right? So basically, it's us spending in the economy, right? In labor. Do you think that it's still a fact from the pandemic withdrawals, right? So we were all given ability to get access to cash,
right?
Or do you think that by 2023 we would have all spent it already? I mean, what to you, what do you think explains this high level of private consumption?
Oh no, so when I say high level, I mean just in percentage terms, right? So not really in absolute growth.
Yeah.
To your question, it's probably spent all by now. Right? I mean, you just buy one TV, it's kind of gone, right?
Yeah.
So, okay, maybe not TVs in today's age, like now TVs are a lot cheaper.
Okay.
But one iPhone, But importantly, it doesn't seem to have come from GFCF or CAPEX. It doesn't seem to have come from exports either. So if I look at it, if I try and eyeball the exports amount, right, it doesn't even seem to register. I mean, I'm not sure about this, but it doesn't seem like the exports is very large.
Right.
And you would have thought the semiconductor component would be a big contributor to last year's GDP growth, right?
Yeah.
So apparently not, because semiconductor in Malaysia is E&E. And E&E exports are about 30% of our total exports.
Right.
And I'm sure you've all heard the news about how we are 11% of semiconductor back-end manufacturing, right?
Yeah.
So this was a surprising news to me.
Okay.
Yeah.
But I think the anticipation is that it will improve because there have been a lot of semiconductor-related news lately, right? Especially this year.
Including AI and data center. So we'll talk about a bit more about that later in the 2024 outlook.
Okay, so on that basis, does it look like we have recovered from the pandemic? Or are we still like really feeling the pinch? I mean, I think personally, and even like a lot of friends in business and all that, this is still an ongoing narrative, right? The pandemic, there's still like sort of lingering effects. What does the picture look like when you look at the actual data?
So it actually looks pretty decent, right? So I'll give you 2 data points to not delude you with data. But first of all, tourism activity has rebounded. Number of tourist arrivals, 2019 was 26.1 million. In 2020, it fell to 4.3. In 2021, it went to 0.1. 2022, it came to 10.1. So 10.1 is about less than half of 2019 numbers. In 2023, it was 20.1, which is comparable to 26.1 pre-pandemic. And I don't really, I mean, the data doesn't really show what's the breakdown of the countries. But it's pretty good news, right? From a tourism
Do I see
standpoint.
more tourists?
Actually,
I mean,
not
they're,
really.
they're there, I guess.
And-
But maybe they're all Singaporeans, so they look like us.
Okay, but I think a counterpoint from a very feeling kind of sense is that tourism will actually help retail sector. And if you ask any retail businessman in 2023, they will tell you it has been a bit muted. Right? So how does that jive? I don't know. Right? But we're just telling you about the World Bank data. I'll give you the second data point, right? So that's about bank loans. So if you look at figure 33, right, in the World Bank report and figure 34, you'll see 2 very startling statistics, right? So this shows figure 33 shows a chart of outstanding loans to households and businesses. And you see the combined grey line, it has improved a little bit. But the blue line that is contributed by household loans is quite flat. The one that has contributed to a lot of house loan increase is actually business loans. And why do I find this particularly surprising is because if you look at figure 34, a big chunk of the growth in business loans, so this is approved business loans, right? Is actually from SMEs. Right? About half is from SME and another half is from non-SME. So if you see non-SME, like big companies having higher loan approvals, you may not necessarily feel excited by that, right? But small businesses being the backbone of the economy, if they are getting more loans and being approved for it, any economist would call that a leading indicator, right? And I think this might spell optimism for 2024, right? I think it's a bit premature to confirm it, but this is a great sign. It's a really good sign.
Let's we say SMEs are the ones that are worrying, or it's just lumped in?
They call it SMEs. I mean, I don't know the actual definition.
Okay. So SME loans are increasing.
Yeah, and the
borrowings, right?
So let me tell you where the spike started from October 2023. Like from the start of the chart was July of 2022. It kept falling all the way to October 2023. And then it recovered by more than half in 2 months. Because the end of the report was obviously December 2023. Right? Doesn't that feel good? I mean, at least it feels good, right?
No, I'm just trying to figure out what drove a sudden need for capital in the last 2 months.
Right. No, I think, and specifically from SME, so it's not like FDI stuff. And I think something worth mentioning is that there is typically a lag between investment and consumption. So perhaps now you may not feel it, but the data here by the World Bank no less is actually telling us that businesses are seeing optimism. And that may or may not imply that by say June, right, we'll start to feel it from a consumption perspective, where people are more, consumer sentiment is higher, consumer confidence is higher.
Yeah.
business confidence is higher,
Yeah.
and that has a self-fulfilling cycle.
So this is not reflected in the report. I don't think so. But our last episode, right, we actually spoke about the new APF account tree. So there's going to be withdrawals. We expect there will be withdrawals. So that probably also will lead to additional consumption, right?
Yes.
The other thing that I think, I mean, there's no reference for this, but I feel that we definitely will get the subsidy rationalization very soon.
Right.
So that will also make it, the effect of that will be will offset some costs, especially for the lower income groups, right?
Right.
So maybe those are things that we can also look forward to that will drive consumption even further.
Yeah, and actually, from an economic point of view, this is traditional Keynesian stimulus. Not trying to justify anything, right? But it is what it is, right?
Right. So as I mentioned, I didn't look at that report, but I think I shared with you in one of our conversations, like P2P lending, right? So P2P, which really falls under the Securities Commission. So this is not like, it's not your bank financial institutions, right? It's non-bank financial institutions.
Shadow banking. It is shadow banking.
Okay. So I looked up the SC report. So 2022, the amount of loans was 1.58 billion. 2021 was 1.14 billion. Right. I'm sure it's much smaller in comparison to bank, like official bank loans, right? Because this P2P is like a smaller chunk of liquidity.
Yes.
But generally, the people who lend from P2P are smaller businesses. Traditionally, will not get loans from banks, right? So
Correct.
Even this, maybe this is a small data point to add on that even in this P2P space, it is actually trending upwards. So I think it jumped by almost 38%. Yeah, okay. 38% from 2021 to 2022.
And anytime there's positive correlation between several data points, that's kind of what economists look for.
But interestingly, so talking about, I don't know what this says about optimism or not, but I think it definitely says something about the need for access to credit. So like 69% of these loans, the P2P loans, right, were for investment notes of 3 months or less. So it's very short-term loans.
Working capital.
Yeah,
loans,
working capital. So but if you're loaning for working capital, it's either you really need the capital. I don't know, what does that say? Either you really need the capital to meet short-term needs.
Yes.
Or you are, you just can't get it from the banks anyway. So this is your only option.
Right.
But anyway,
that could be the alternative explanation.
Yeah. Also very interestingly, 70% of those loans were for 50K and below. So it's really small short-term loans.
Yeah.
But that explains why this sector, right, this P2P part of the loans, right, is only like, I think, 1.58 billion. Is there an indication how big the loans are for the bank sector?
I mean, if we're talking about financial sector, the loans will be much bigger than just 1 billion. Right? So, but again, I think we just need to look at the correlation. It seems like they're telling the same story, so they cross-verify each other.
Right.
Yeah, I think that's good enough.
Okay, but so the other thing that we spoke about, and I think also all of us can relate to, right, which is our interest rates.
Right.
We spent a whole episode on this.
Yeah.
Right. In fact, actually, I think 2 episodes. Right.
Okay.
We did one on to explain our interest rates, and then we also did one on the 4 different types. That was a more conceptual episode on interest rates,
Right.
But I think interest rates was a very hot topic. For the past few months, and I think it will be for a while because I don't think it has improved by that much. And one thing, Aaron, you remember when we recorded that episode, the sentiment was that US is going to actually start lowering. Now I think it's changed, right? It seems like we're not sure. It might actually last for a bit longer.
It might actually just turn around. You never know.
Yeah. So that might mean that the pain for this interest rates is going to linger for a while more.
Yes.
Right, and that affects our forex.
Right.
But I'll throw it back to you again. What is let me clarify. When I say official, actually this is not official. It's World Bank, right? So it's a third party, right? It's not the government's position on this. It is the World Bank reporting on this. It's fair to make that a caveat, right? I think.
Okay.
Yeah.
Sure.
I mean, it's a World Bank.
Right.
It's a neutral party reporting on the giving the report card.
Okay. Okay. So your question is with regards to
the interest rates and forex.
Oh, okay. Right. Okay. Actually, it's interest rates. You mean inflation?
Yeah.
Right?
Sorry, inflation. Yes.
Right. Okay.
Yes.
Because interest rates are related to inflation because you need to counter it.
Okay, everything I said there, you just replace interest rate with inflation.
Sure. Okay. So back to your question, right? What does the World Bank say about inflation? Malaysia's headline inflation, according to the World Bank, is actually lower than many of our peers, right?
Okay.
So when we talk about peers, we talk about emerging market peers. And specifically, they make reference to Vietnam, Indonesia, Philippines, and Thailand. Only Thailand seems to have lower inflation than us. And if you know Thai economics, you will know that they are currently in a pretty bad shape right now. But others are a bit higher than us. Okay, this in itself doesn't tell us much because they are also more emerging than us. So expected to have higher growth and higher inflation. But what may be more relevant to the everyday person would be the composition of our CPI.
Okay.
Right. So we have all felt the increase in our
Loans,
home mortgage loans, our groceries, right?
Yeah, which was quite painful lah.
So, economists split inflation CPI into two components: core and non-core. Non-core means food inflation and energy inflation. And the reason why it's non-core is because these two are very volatile year on year.
Right.
So if you only look at the headline inflation, right, it goes up and down like that. But what really matters is the core inflation, which is everything else. And those things don't tend to change much. Think about your rent prices. Think about, car prices. Right? I mean, they don't go like this, right?
Right.
So
no volatility lah.
Correct, no volatility. And if I were to eyeball the chart on figure 28, which is showing the composition of Malaysian inflation, right? I mean, honestly, I don't get a lot of insight. It seems like it feels. Oh, okay. There's a graph. There's a line as well. So I'm looking at the line. The blue line shows that headline inflation is coming down, but the grey line shows that core inflation has not come down as much. Right. So it's basically the rate of inflation.
Okay.
But
so the difference will be explained by the non-core inflation.
Yes. No. The difference will be explained. When you say difference, you mean.
Because headline inflation is the combination, right?
Yes.
Right. But you're saying the core has not moved. Did I hear that correctly?
It has come down less than the headline.
Okay.
Right? So that may be where you are feeling the pinch.
Okay.
But I just want to clarify, seems like they have merged, the lines have merged in January of 2024.
Right.
In terms of the rate of growth, because headline inflation increased.
Right.
So that is what I mean by volatility, right? The reason why headline inflation increased is mainly due to food and energy prices going up. And that might have something to do with the oil prices.
Yeah.
Yeah.
Which also is a big part of our revenue.
Right. Sorry, I haven't answered your forex question.
Yeah.
So the reason why we talk about forex together with inflation is because a big chunk of our forex weakening has been due to our domestic inflation. Right? And we can see how, everyone is familiar with the chart of the forex that goes like that, right? That's in figure 30 of the World Bank report. But it's figure 31 that actually compares our performance to peers. They use a metric called REER, which is the real effective exchange rate. And the way this one is counted is, okay, let me take a step back. The REER is a function of the NER, which is the nominal effective exchange rate. How do you count the nominal effective exchange rate? You just take all the major countries that your country trades with, you take their forex, you weight it by the amount of trade, right? So if you trade more with China, it takes a bigger weight, right? Yeah. And then you average the number. That's your NER. Okay, it's a trade-weighted exchange rate. Your RER further adjusted by the domestic inflation of both countries.
Right. Okay.
So basically, it is a real adjusted rate. And we can see in figure 31 that Malaysia is the only one of the 5 countries mentioned that is in negative territory. Right? That means that our domestic inflation is quite bad.
Okay.
Right? So the 5 countries mentioned are Singapore, Philippines, Indonesia, Thailand, and Malaysia. Right? And there's a lot we can get into just from this chart. But the gist of it, as far as it concerns the everyday person, is that Malaysia is underperforming mainly due to high inflation. Right? So in a way, right, the RER is inflation offsetting the trade-weighted forex. Right? And the reason, that means that our inflation far underperforms our trade-weighted forex.
Okay.
Yeah.
So that is inevitably going to bring us back to FDIs, right?
Okay.
Because again, we got into this in a previous episode.
Right.
Remember when we talk about what can we do to drive down inflation, right?
Right.
And or rather interest rates lah, right? And there is a correlation, right?
Right.
So with regards to interest rates, I remember from that episode we spoke about the 4 different mechanisms, and the one that seemed to have a lot of promise was FDI, right?
Yes.
And then, of course, just recently there was the announcement from Microsoft, 10 billion investment. but this is on the back of a couple of other investments, Nvidia, and going back from last year, there was quite a number of other FDI announced as well, right?
Right.
So does that help to a certain extent, or how do we view that story?
Remember we talked in a previous episode about how FDIs affect forex, right?
Yeah.
So it is quite good news to hear that our PM has been, as well as MITI Minister, has been quite successful in courting a decent amount of FDI, right, to help with our forex. Okay, so in response to your question, right, if we look at figure 9 of the World Bank report, this is on page 29, you can see that growth of FDI stocks slowed. And keep in mind that growth is based on the last year's figure, so this may not necessarily tell us too much, right? But it slowed from 12% to 5% in 2023. What was really surprising to me, right, was that in 2023, the bulk of the FDI was actually in the service sector, right? And if you think about it, actually data centers will fall on service, right? Yeah, because it's AI.
Yeah,
right?
well, a lot of it is basically driving your subscriptions, your softwares and stuff like that. Yeah.
Because the other categories would be manufacturing and construction. That doesn't sound like...
Yeah,
okay, so maybe this chart doesn't tell us much. But initially I thought that it was in something like retail, which would have caught me by surprise, right? On a less FDI related note, but more forex related note, we can see exports.
Yeah.
So we also talked in the first episode how our current account surplus is by far the largest component of our balance of payments, and that is represented by our trade surplus. And in 2023, and let me be clear, I'm eyeballing it, but it doesn't seem like semiconductors is a large export. Right? Remember earlier we said how semiconductors is 33% of our exports?
Yeah.
Doesn't really feel like it.
Okay.
Right? Okay. I mean, I'm just putting it out there. Right. The bulk of our exports is under the category of non-semiconductor.
Right.
That's how government or the World Bank categorizes our...
Okay.
They have four categories of exports. Semiconductor, non-semiconductor, non-E&E, and then commodities. So it's like the baseline is semiconductor already.
Semiconductor and non-semiconductor would make up E&E, I'm assuming, right?
Yes.
Yeah.
So actually, I skipped the word E&E. They actually put E&E dash semiconductor.
Right, okay.
And then E&E dash non-semiconductor. But it's interesting that the World Bank of all groups, right, would use semiconductor as our export baseline.
I think maybe because that definitely is the direction that the policies are going to, right?
Right.
So,
But having said that, it doesn't seem to be very large. Okay, but on the current account side, which is really the bigger picture of the trade surplus, we actually saw that goods were a large positive to growth.
Yeah.
But services and primary secondary income were actually negative to growth.
Okay.
So the group headline growth was 0% in 2023.
Okay.
In quarter 4.
So I think maybe one way to reconcile this, right, is that a lot of the announcements are exactly that, as announcements. It's going to take time for it to actually be realized, right? It has to be approved and all that. So there's always a difference between the what is announced and the actual approved FDIs,
right?
Which is definitely going to take time, right?
Yes.
So Microsoft said 10 billion. It's probably going to take easily maybe half a year.
Actually, in Microsoft's specific case, I'm not sure because they said they will spend it over the next 3 years, if I'm not wrong.
Okay.
Yeah.
So, but there's a lag, right? There's
yes,
a lag.
Yes.
So maybe one way to explain this is that the announcements drive optimism, right?
Yes.
But the actual realized investments were actually going to take time, So it probably doesn't show up in the numbers yet.
Right.
So you can take the pessimistic or optimistic view. The optimistic view is that it's going to come. So maybe it'll be reflected in next year's report, right?
I mean, we call it economics, the dismal science for a reason, right?
Okay.
You can interpret it 2 ways.
Right. Okay. Yeah. So I want to maybe ask about something that we touched on earlier as well. Like you mentioned that, there's the data tends to show that there's optimism in terms of on the business end, right? Because the loans are growing and stuff like that. But in order for that to happen, then the financial institutions need to be strong, right?
Yes.
Because that is the backbone of providing this liquidity and stuff like that.
Yes.
So I'm just curious to know where we are in terms of the financial sector.
Right. I think an easy analog to compare to would be the US subprime crisis. You don't want a banking sector to crash.
Yeah.
And also the Chinese current banking sector is not doing so well. So a strong financial sector is very important. And let me just digress for 1 minute to give you a bit of context.
Okay.
Malaysia's banking sector is very, very conservative because it got scarred during the Asian financial crisis. So I think our governments basically promised to never take risks, which is part of why our 30% KLSE, which is 30% banks, is so sluggish, right? I think that's a big part of it.
Okay.
But the flip side of sluggish and conservative is low risk, right? And we can actually see that in the figures. So the figure 32 shows the total capital ratio, and our CET1 is about 14.6%, which is very, very good. I think globally from Basel III is only about 10% requirement. Right? And all our Malaysian banks do that. They are way above the minimum requirement. And I think more relevant to the current recessionary mood would be what are the impaired loans ratio like. So the gross impaired loans ratio, which is GIL, has actually been flat at around 1.65 since October of 2020. Right? It hasn't actually, it seems like it actually improved a little bit.
Just to add, right, I think that maybe the saving grace there was that there was a moratoriums, right? So the moratorium saved a lot of these accounts.
Yes.
Right? Because otherwise maybe it would have been
it's true.
Right? They would have actually like failed to pay and stuff like that. So the moratorium maybe helped as well.
It's true, but whether or not we cheated, the fact is the result, it didn't collapse, right?
Yeah. Well, so I'm not inferring that it's cheated.
I think
it's
just trying to.
I view it as, we talk about this a lot, as creative approaches.
Right? Unconventional monetary policy. Right? Okay. But it seems like our GIL ratio on a headline basis is great. What is not doing so well beginning from start of 2023 is the category called wholesale, retail, and hospitality. And this one really means retail, service sector, as well as wholesale is also retail, right? Yeah, I think this one is not doing so well because it seems to have increased from slightly below 2 to currently 2.35.
You're talking about the default rates, right?
This is the impaired loans ratio. So impaired loans normally means, I think, 90-day delinquency.
Right, okay.
Right? Yeah, something like that.
Okay.
Right. Another less important part is mortgages are still by far the largest component of our household debt. Interestingly, the 3 years they gave us was 2007, 2015, and 2023. Credit card debt was 5.5% in 2007, 3.5% in 2015, and 3% in 2023, right?
Okay.
So this is, of course, a share of household debt. And we all know household debt has increased. But the share hasn't really increased. In fact, it has declined. Mortgages have increased, right, from roughly 55% to 60% today.
I wonder if that credit card has to do with just a lot more like different liquidity products, right?
I mean, it could be, but actually, I don't think it's very insightful. So let me explain why. Credit card debt, an increase in credit card debt has been interpreted two ways. Right? If let's say you see the credit card debt increase in, let's say, the US economy, right? I've seen both bulls so bulls will make the argument that economy is stronger, people are feeling more confident, so they spend more.
Right.
The bears will say that people need more are tight on cash, so they have to turn to their credit card. So I think in and of itself, it doesn't really tell you much.
Okay. Can we move on to the? So I think I have only one final point before maybe you give us an overall outlook. Right. I think this probably would encapsulate all that we've talked about, which is really about the government revenue, right, and government debt. Even the Prime Minister himself very publicly says that, there's sort of a tighten our belts a little bit from a government perspective.
That's Rafizi, right? Economy Minister.
No, even the Prime Minister. There was a clip, I think just a couple of days ago, someone asked him about toll roads and stuff like that. Why can't we do away with toll roads and stuff like that? And he says but it's a fair response, right? I mean, if the government doesn't have as much capacity to do something, then the reality is that you don't have the revenue to do it,
Yes.
Right. But anyway, I mean that's a fair argument for any government to make, right? It's always going to be a function of how much money you have, which will influence what you can do. But okay, that aside, what is the view on our revenue and debt?
Our government debt has actually increased to around,
I was just guessing, but I'm not surprised.
I mean, obviously increased during pandemic, right? So remember, like our previous episodes, we were talking about how government debt increased to help the lower income cohort, right?
Yes.
So that was mainly the reason for the increase. But I think what is more relevant to listeners would be our debt service ratio has increased to about 15%. So it's 14.7% in 2023, right? And the administrative limit, right, is 15% of total revenue. So, if you are going to get angry about something, it shouldn't be EPF withdrawals. It should be this, right? Because this is a current worrisome trend, right? I mean, the basket case here would be Japan, which is paying like 100% of their revenues in interest rates, right? And without going into it too much, I think intuitively we all know it's a disaster, right? So the administrative safe limit is 15% of your income as interest expense.
For interest payments, okay.
Right? So for a government, that's really bad,
And right now we are at 15?
We are at 14.7, and World Bank expects that next year will be 16.2.
Okay.
So just call it 15 to 16, right?
What is the real implication here?
Basically,
I mean, is it? It is a self-imposed benchmark, right?
In a way, yes, but it's also about health, right?
Yeah.
So let me just talk about Japan to just illustrate why it's so dangerous. When you are paying 100% of your interest of your revenue as interest expense, it means that you cannot
do anything
have
else.
Enough money for anything else.
Yeah.
Right? Like that's so it takes away from it.
Yeah.
So if you have higher interest expense, I think it's quite logical to understand that you will need to take it from somewhere else.
Yeah.
You gotta pay your teachers less, you gotta fix your roads less.
Yeah.
Right? It's gonna eat into your debt. I mean, debt is debt for a reason.
So I'm just gonna from a very simplistic point of view. So if it's 15%, you still have 85% to play with. Is that really like a rate line?
In a way, yes, but I think it is more instrumental to think about it as a share of GDP.
Okay.
So this is share of revenue.
Right? Share of GDP will be much higher, right?
Yeah, your share of your share of GDP will be lower. But you gotta remember your tax rate, right, is 20%, and perhaps even less than that, right? So your cost is a function of your GDP.
Yeah.
Right? And then it's not 85% to like for like kind of.
And that was on debt, right? What about revenue?
Right. Okay. So from a revenue perspective, quite frankly, there's not a lot of like interesting stuff here, but I'll just share. Okay. So basically, our petroleum-related revenue fell as a share of revenue, and the main reason of that was due to oil prices, right? According to the World Bank. And the revenue collection has also declined slightly to 17% on. Okay, sorry, it was 17.3% in 2023, and World Bank estimates it will fall to 15.6% in 2024.
Okay.
So I don't really know what this breakdown is, but you can check it out and figure.
This is revenue, right?
This is revenue source, yes.
Okay.
From tax revenues and non-tax revenues.
Okay. I chanced upon Apurva's Twitter account, X account. Right. So he's actually if I'm not mistaken, the lead economist at World Bank in Malaysia.
Right.
So he definitely would have been responsible for this report as well. So I know this report probably gives a snapshot at that particular period, right? But he had an interesting case where he said that if you look at 2012, and he actually shared a chart of this, anyone can go and look up his account.
Maybe we can remember to put the link in this time.
Yeah, okay, we'll put a link. So in 2012, our revenue as a share of GDP was 21.4%, right? So that is in 2012. So 2020. So as you mentioned, right, currently it's going to be about 15%. So his argument was that actually, if you look at a longer time view, also it actually has been falling, right? So that's 23% in 2012. Right. So it's like there's a downward trend of revenue, right?
Okay, hold on. Let me clarify it for your listeners.
Yeah.
So basically, you are saying that as a share of GDP,
yes,
our revenue has been going down.
Yes.
Right? Okay.
Yes. Yeah. And also the amount that the expenses by the government,
right?
Also, meaning that the capacity to spend, right? I mean, your expenses is what you can spend on, right? Coming back to this, why can't you abolish tolls and all that? You have to spend, right? So again, he showed on the same graph, in 2012, expenses as share of GDP was 25%, and the current value is about 20.5%. So even we are spending less also.
Yes.
and over that 11-year cycle. So both on both metrics, it actually sort of slowly falling.
Okay.
Right. So
so let me double clarify. So basically, what you're saying is, as a share of GDP, both tax revenue as well as government spending has fallen at the same time.
Yes.
Over time. Okay.
Yeah. And the fall is, it's not like it's spiking like, it's actually, you can see the
linear.
Yeah.
Okay.
So, and I think that has implications for moving forward, which is also why I think that there's more focus on trying to bring in FDIs and stuff like that. What else can be done? And that might also be influencing some of these unconventional monetary policies in terms of, if the government cannot spend, then you allow people to spend, from EPF and stuff like that. Maybe, right?
Maybe, yeah. So basically, I think he actually gave a very good quote, right? He was saying that we have transitioned from being a high income, high spend economy to a low income, low spend economy as a share of GDP.
Yeah.
So we used to be the rich guy who earn a lot and spend a lot.
Yeah.
And now we are the poorer guy who earn less and spend less.
Yes.
Right? So on the surface,
like all of us.
yeah, okay. We're talking about government here, right?
Okay.
Oh, but we are all part of the government, right?
Yeah.
So
we are the government.
Yeah. So the idea being that even though on a profit or GDP basis, we may appear to be roughly the same, the reality is that we have changed our financial profile. Right? We are spending less and earning less. That's why it feels less as well.
Okay.
Right? Okay. I think this is a good segue into the topic of GST.
Right.
Because I think what he was arguing for is that rather than asking the government to spend less, we are already spending less.
Right.
And we actually need to focus on earning more.
How much more can you tighten the belt?
Right. So when we say earn more here, we mean government revenue. Right. And the primary debate here will be about tax revenue. Right. Not non-tax revenue. And this is the case for increasing our taxes, like GST. I mean, in economics, we have a term called NIMBY, not in my backyard. So we all want the government to do a better job, but we don't want to bear the cost when it's our turn to pick up the tab.
Yeah.
Right? And I think that the GST argument needs to be resurfaced. Right? Keep in mind that I'm also going to suffer, okay, from higher taxes. So, but just from an academic point of view, tax revenue increase is a very important need going forward. And GST, I think, will be supported by most economies.
Okay. So with that, can you do like a outlook for 2024, and also summarize what is the view? Should we look at this report card optimistically or pessimistically, or neither? Okay.
So I'm going to recap a bit of what we said just now. So what we covered was growth, pandemic recovery, FDI, inflation, forex, financial sector health.
Yeah.
As well as government debt and revenue.
Yeah.
Okay. So I think the relevant parts to pull together here would be obviously growth, inflation, because inflation affects growth, as well as government revenue and debt. Okay, I think the good news, we have several positive data points. So one, tourism is on the rise. Hopefully it will increase. Maybe you can follow AirAsia more closely for that. And then that informs progress from pandemic recovery. I think a big legitimate chunk of our lower GDP growth has been from outsiders. We did cover this in the first episode, right? So if US and China both improve, that should help our forex as well, right? So when I say improve, they improve in different directions. China will go up, US interest rates will come down, right? And then for government debt and stimulus, I mean, we can look forward to a country withdrawals giving a Keynesian boost, right? Keynesian stimulus. And it seems like consumer sentiment is picking up as well, right? From the business loans and data. So of course, this is not going to be an exhaustive list of data, but the World Bank actually on page 60 of its report said that risks to Malaysia's growth outlook remain tilted to the downside, which contrasts with our earlier positive data notes, right? And the reasons they gave were twofold. One is Malaysia will continue to face considerable downside risks from the external environment, which is what we covered, right?
Yeah.
Domestically, the key downside risks relate to uncertainty over strength of household consumption. So we also saw how service sector was the biggest contributor to GDP growth, right? And hopefully the tourism recovery will help. I actually haven't looked at how big China's share of tourism is. I imagine it will be a big chunk. So there is uncertainty, but there are also positive data points. Right? And they specifically mentioned that successful fiscal reform is necessary. Personally, I think GST is a must. Right? The debate needs to come back. It's really managing optics more than fundamentals. Yeah.
Okay. So
so that's our Malaysian report card 2023.
Yeah.
So how many stars do I give it?
I would say okay, let's do that.
Yeah,
out of 10. Okay, let's do 10. Scale of 10.
Maybe 5.5.
Really?
Yeah. No, in the sense that
okay, this 5.5 is for 2023.
2023.
Okay.
So in the sense that most people's baseline will be around 3.5. Right? That's the feeling for 2023. I would say that there has actually been positive data points that we have mentioned that happened really in the last 3 months of the year. And that may inform a slightly more positive outlook in 2024, especially the account trade withdrawals. I'm sure retail businesses are quite happy with the news, right? And there will also be a lot of families who will be a bit happier from the cash flow. So, I mean, stimulus is good, right?
Okay.
So,
all right.
Yeah.
Okay, so let's hope that it picks up from there for this year, 2024.
Yeah.
Maybe what we'll do is we will make it a point to, when the next report card comes out, which I anticipate will be sometime next year, right? We can revisit that as well.
Right.
Yeah, and I would urge our readers to, go and read this report. I think it's sometimes you always think that is the report is meant for people in the industry, for government policymakers and all that. No, but I mean, credit to the World Bank. Actually, it's quite an interesting read.
Yes.
It's very colorful, right? It's a good, and I think coming back to our tagline as well, what we believe in, right, is like, this is all, economics is something that all of us should be better at,
right?
Because it actually affects our rice bowl. Right. So do read it. It's freely available to download from World Bank Malaysia website. And yeah, we look forward to looking at the next report as well.
Right. And if you guys have any questions that you want us to answer, please leave them in the comments below. So I've already read the report. I'll be happy to try and answer as much as possible.
All right. Okay, and with that, that's this episode, and we see you at the next episode.
Bye.